Good day, everyone. Today, we are going to continue our discussion for our last topic, which is financial management and accounting in the global firm. So, let's begin. International financial management involves the acquisition, use, and management of funds for international business activities. These activities can include cross border trade, investments, and other commercial ventures. There are several key participants in international financial management. Firms, which can be domestic or multinational enterprises, need to manage their international finances. Banks and other financial institutions facilitate these transactions by providing loans, currency exchange services, and other financial products. Brokerage houses play a role by connecting firms with investors in the global capital markets. Finally, financial managers, such as chief financial officers, oversee the financial activities of firms and make strategic decisions related to international finance. Before we discuss our topic, the following slides will provide you the key terms that we will encounter throughout the discussion. First is equity financing. It is the issuance of shares of stock to raise capital from investors. When a company issues shares of stock, it is selling a piece of ownership in the company to investors. Investors who buy shares of stock become shareholders. Shareholders are entitled to a portion of the company's profits and have a say in how the company is run. Next is debt financing. It is the borrowing of money from banks of other financial intermediaries or the sale of corporate bonds to individuals of institutions to raise capital. So, debt financing refers to raising capital by borrowing the money and agreeing to repay the entire amount plus the agreed on interest at a specific date in the future. Firms can borrow money from banks or by selling bonds. The advantage of raising money through debt financing is that company management doesn't give up any ownership of the firm. Bond is a debt instrument that enables the issuer or the borrower to raise capital by promising to repay the principal along with the interest on a specified date or also known as the maturity date. Now let's go on to the different markets. The global money market is the collective financial markets where firms and governments raise intermediate and short term financing. The global money market is a highly liquid market, meaning there is a lot of buying and selling of short term securities. The most common instruments traded in the global money market are treasury bills, commercial paper, and certificates of deposit. Next is the global capital market. It is the collective financial markets where firms and governments raise intermediate and long term financing. The global capital market is less liquid than the global money market, meaning there is less buying and selling of long term securities. The most common instruments traded in the global capital market are bonds and stocks. On the other hand, the global equity market refers to all stock exchanges worldwide where firms can buy and sell stock for financing and investment. And euro dollars are US dollars held in banks outside the US, including foreign branches of US banks. Euro dollars are a major source of funding for banks and other financial institutions around the world. A euro currency is any currency deposited in a bank outside its country of origin. For example, if a US dollar is deposited in a bank in London, it becomes a euro currency. Next is the global bond market. It is the international marketplace in which bonds are bought and sold. And we have here the two types of bond, the foreign bond and the euro bond. A foreign bond is a bond sold outside the issuer's or the borrower's country and denominated in the currency of the country where issued. For example, if a Japanese company issues a bond in the United States, it would be considered a foreign bond, while a euro bond is a bond sold outside the issuer's home country but denominated in its own currency. For example, if a Japanese company issues a bond in the United States, but the bond is denominated in Japanese yen, it would be considered a euro bond. Next, we have here the intracorporate financing, fronting loan, and multilateral netting. Intracorporate financing refers to funds from sources inside the firm, both the headquarters and the subsidiaries, such as equity, loans, and trade credits. This type of financing is typically used to fund the operations of the firm's subsidiaries. A fronting loan is a loan made between a parent company and its subsidiary through a financial intermediary such as a bank. The advantage of using fronting loans as a way to lend money, rather than the parent lending the money directly to the subsidiary, is that the parent can gain some tax benefits and bypass local laws that restrict the amount of funds that can be transferred abroad. With a fronting loan, the parent deposits the total amount of the loan in the bank. The bank then lends the money to the subsidiary. For the bank, the loan is risk free because the parent has provided the money to the bank. The bank charges the subsidiary a slightly higher interest rate on the loan than it pays to the parent, thus making a profit. And last, multilateral netting is the process of strategically reducing the number of cash transfers between the parent and subsidiaries by eliminating the offsetting cash flows between these entities. Strategic reduction of cash transfers within the M&E family through the elimination of offsetting cash flows. So, multilateral netting is a technique which companies use to reduce the cost of cross border payments between subsidiaries. Three or more subsidiaries must participate. If only two participate, the technique is known as bilateral netting. Next, we have the different types of exposure. First is the transaction exposure. It is the currency risk firms face when outstanding accounts receivable or payable are denominated in foreign currencies. Next is the economic exposure. It is the currency risk that results when a firm translates financial statements denominated in a foreign currency into the functional currency of the parent firm as part of consolidating international financial results. And the last is the translation exposure. It is the currency risk that results from exchange rate fluctuations affecting the pricing of products, the cost of inputs, and the value of foreign investments. These three types of exposures will be further discussed. We have the consolidation. It is the process of combining and integrating the financial results of foreign subsidiaries into the financial statements of the parent company. It provides a more comprehensive view of the company's overall financial health and performance. It enables investors and analysts to better assess the company's global operations and risk profile. It improves comparability with other companies that also operate internationally. We have here the hedgers. Hedgers are currency traders who seek to minimize the risk of exchange rate fluctuations, often by entering into forward contracts or similar financial instruments. So, hedgers are individuals or entities who use financial instruments to mitigate the risk of adverse foreign exchange rate movements. They are not necessarily professional currency traders, but they understand the potential dangers of currency fluctuations and take steps to protect their financial interests. Businesses that engage in international trade or have foreign operations are prime examples of hedgers. They might use foreign currency derivatives like forward contracts or option contracts to lock in exchange rates for future transactions, protecting themselves from unexpected currency swings that could impact their profits. Another example are investors. Investors with holdings denominated in foreign currencies can also be hedgers. They might use options or other instruments to hedge against potential losses if the foreign currency weakens against their home currency. And another example is individuals. People who travel internationally or have income or expenses in foreign currencies might also hedge. We have arbitrators. It is the currency traders who buy and sell the same currency in two or more foreign exchange markets to profit from difference in the currency's exchange rate. Arbitrators are like ninjas of the financial world. They are traders who exploit tiny weaknesses in the system to make quick profits. In the foreign exchange market or the forex, These ninjas are called currency arbitrageurs. They take advantage of price differences in the same currency across different markets. To continue, we have here two types of contract, the forward contract and the futures contract. In the forward contract, the firm agrees to pay a specific rate at the beginning of the contract for delivery at a future date. Thus, the firm will pay the agreed on exchange rate regardless of what the current exchange rate is at the date of the final settlement. There are costs associated with using these instruments, such as premium pricing, bank fees, and interest payments. But companies often prefer to protect themselves against a potential larger downside loss, even if they have to pay extra to avoid that bigger loss. While on the other hand, a futures contract is a standardized legal agreement between two parties to buy or sell a specific underlying asset, which can be a commodity, security, or even a financial instrument at a predetermined price on a specific future date. Futures contracts are designed with specific terms like quantity, quality, and delivery location to ensure they are easily tradable on a futures exchange. This standardization allows for efficient trading and price discovery. Now let's go on to the currency option and currency swap. A currency option is a financial derivative contract that grants the buyer the right but not the obligation to buy or sell a specific amount of a particular currency at a predetermined exchange rate on or before a specified expiry date. Unlike a futures contract, which obligates both parties to buy or sell the underlying asset, a currency option gives the buyer the flexibility to decide whether to exercise the option or let it expire worthless. And when we say currency swap, it is a financial agreement between two parties involving the exchange of principal amounts and interest payments denominated in two different currencies. Companies can use currency swaps to hedge against foreign exchange risk associated with foreign operations or international trade. A company might be able to borrow at a more favorable interest rate in another currency through a swap. Currency swaps can be used for speculation on interest rate movements in different currencies. For the last four terms, we have transparency, current rate method, temporal method, and tax havens. Transparency is the degree to which companies regularly reveal substantial information about their financial condition and accounting practices. When companies are transparent, investors have more faith in the accuracy and reliability of their financial information. This can lead to a higher valuation of the company's stocks. Next, the current rate method. It is a method of foreign currency translation in which items in the subsidiary's financial statements are translated into the currency of the parent corporation at the current exchange rate. In this case, the current value may be different on the day it's translated than on the date when the assets were originally purchased. Although this difference is only a paper gain or loss, it nonetheless affects the valuation of the firm. This method is the most widely used currency translation method. Another method is the temporal method. It is a method of foreign currency translation that uses exchange rates based on the rate in place when the assets and liabilities were originally acquired or incurred. The temporal method avoids the paper gains or losses problem of the current rate method, but because subsidiaries purchase assets at different times throughout the year, the multinational firm's balance sheet may not balance if the temporal method is used. And for our last term, we have tax havens. The tax advantages of fronting loans can come into play if the loan is made by a subsidiary located in a tax haven. A tax haven is a country that has very advantageous corporate income taxes. Bermuda is a well known tax haven. The bank pays interest to the tax haven subsidiary. The subsidiary doesn't pay taxes on that interest because of the tax haven laws. At the same time, the interest paid by the subsidiary receiving the loan is tax deductible. And now let's start our discussion. A core task in international financial management is determining a firm's capital structure. This refers to the mix of long term financing a firm uses to support its operations. The two main sources of long term financing are equity financing and debt financing. As said earlier, equity financing involves issuing shares of stock and retaining earnings within the firm, while debt financing involves borrowing money from banks and other lenders or selling bonds to investors. The ideal capital structure for a firm will vary depending on a number of factors, including the firm's size, industry, risk tolerance, and access to financial markets. International financial managers need to consider these factors when making capital structure decisions for their firm's international operations. Next, we have the raising funds for the firm's international activities. Firms can raise funds for their international activities through a variety of channels. They can access the global capital market, which consists of stock exchanges and other financial markets around the world. Equity financing can be obtained through global equity markets, where firms can list their shares on foreign stock exchanges. For debt financing, firms can borrow in the euro currency market, which involves borrowing and lending currencies outside of their home country. Additionally, firms can raise funds by selling bonds in the global bond market. These bonds can be foreign bonds denominated in the currency of a country other than the issuer's home country, or Eurobonds denominated in the issuer's home currency but sold outside of their home country. Another option for raising funds is through intracorporate financing. This involves transferring funds between different parts of a multinational enterprise. For example, a parent company might lend money to its subsidiaries in other countries. For our third part, we have the management of working capital and cash flow. Cash flow is the lifeblood of any business, and managing it effectively becomes even more critical in an international setting. Efficiently managing the flow of money in and out of our international operations is critical for success. IFM helps us develop strategies to optimize inventory levels, manage receivables and payables effectively, and ensure smooth cash flow across borders. This not only ensures we have enough funds for day to day operations, but also helps us capitalize on new opportunities as they arise. The foundation lies in understanding net working capital. This is simply the difference between your company's current assets and its current liabilities. A healthy net working capital indicates sufficient resources to cover short term needs. Now, managing funds across a global network can be complex. Many MNCs establish a centralized depository. Think of it as a central pool of funds. Subsidiaries that generate excess cash can contribute to this pool, while those with funding needs can access it. This streamlines cash flow and optimizes resource allocation within the company. But how does the actual transfer of funds happen? The various methods for transferring funds within the MNE includes: one is dividend remittance. Profits from a subsidiary can be sent back to the parent company as dividends. This is a straightforward approach, but tax implications need to be considered. Another is royalty payments. The multinational companies can charge its subsidiaries royalties for using intellectual property like patents or trademarks. This provides a way of transferring funds while potentially offering tax advantages. Another is transfer pricing. This involves setting prices for goods and services traded between different subsidiaries of the MNC. Transfer pricing strategies can be used to manage profits and cash flow across borders, but regulations need to be followed carefully. And the last method is defronting loans. A subsidiary with a strong financial position can provide a loan to another subsidiary in need. This allows for internal financing but requires careful management to avoid financial strain on the lending subsidiary. And then we have here the capital budgeting for international operations. Capital budgeting is the process used by companies to assess for financial attractiveness of major investments, especially those related to international projects. By carefully analyzing potential projects, companies can make informed decisions about where to allocate their limited resources. One of the key tools used in capital budgeting is net present value, or also known as the NPV. A positive NPV indicates a project is expected to generate a positive return on investment, making it a financially viable option. Let's go on to the management of currency risk. There are three main types of currency exposure: transaction exposure, economic exposure, and translation exposure. Translation exposure is about the immediate currency risk associated with outstanding financial obligations like receivables and payables. It focuses on the impact of exchange rate fluctuations between the time a transaction happens and the settlement. An example for this is if your company exports furniture to a customer in Europe and you agree on a price of 10,000 euros for the furniture, then the customer pays you later. Transaction exposure comes into play because of the time difference between the sale and the payment. If the euro weakens relative to your home currency, let's say US dollars, during that time, you receive fewer dollars when the customer finally pays you the 10,000 euro. Here is why it is considered a risk. So you had planned to receive a specific amount in your home currency, like US dollars, based on the exchange rate at the time of the sale. A weaker euro means you get fewer dollars, impacting your profits. And the same situation applies to accounts payable. If you import materials from a foreign supplier and owe them money in their currency, let's say Japanese yen, a stronger yen compared to your home currency would mean you need more of your home currency to settle the debt. So we have the economic exposure. Economic exposure, on the other hand, deals with the broader impact of exchange rate changes on a company's overall financial health and future cash flows. It arises when a company translates the financial statements of its foreign subsidiaries into the functional currency of the parent company for consolidation purposes. Economic exposure is a long term risk compared to transaction exposure, which is more short term and focused on specific transactions. It is more important to note that economic exposure is a non cash accounting concept, but it can significantly affect financial ratios used for analysis and investment decisions. And the last type is the translation exposure. It is the currency risk that results from exchange rate fluctuations affecting the pricing of products, the cost of inputs, and the value of foreign investments. Transaction exposure focuses on the immediate risk from outstanding foreign currency obligations. Economic exposure deals with the broader impact on a company's overall financial health due to exchange rate fluctuations during consolidation. Translation exposure sits somewhere in between these two. It specifically refers to the accounting impact of exchange rate changes on the reported financial statements of a company with foreign operations. Unlike transaction exposure, translation exposure doesn't necessarily translate into immediate cash flow losses. It's primarily an accounting consequence that affects the reported financial performance. However, it can still impact investment decisions and financial analysis based on company reports. While translation exposure itself isn't a cash flow risk, it can be an indicator of potential future cash flow risk if the underlying business dynamics are affected by exchange rate fluctuations. Now, moving on to the next slide. Currency trading takes place between banks and currency brokers. These institutions facilitate currency transactions, often acting on behalf of multinational firms. Currency traders include hedgers. These are companies seeking to minimize the exposure to currency risk and protect their profits from exchange rate fluctuations. Speculators. These market participants aim to profit from short term movements in exchange rates by buying and selling currencies. And arbitrageurs. These traders exploit tiny price differences in currencies across different markets to make quick profits. Managers attempt to forecast exchange rates to minimize their firm's exposure to currency risk. Approaches for minimizing exposure to currency risk include centralizing currency management, measuring currency risk, monitoring long term trends, and emphasizing flexibility in international operations. For centralized currency management, establishing a central team to oversee all the company's foreign exchange activities ensures a coordinated and strategic approach to managing currency risk. For measuring currency risk, developing methods to quantify the exposure to currency fluctuations will help in prioritizing risk mitigation efforts and allocate resources effectively. For monitoring long term trends, stay informed about global economic and political trends that can influence exchange rates. By anticipating potential shifts, you can adjust your hedging strategies accordingly. And for flexibility in international operations, consider structuring international business activities to be adaptable. For example, negotiating contracts with variable pricing clauses can provide some protection against currency fluctuations. Firms also employ hedging, the use of specialized financial instruments to balance positions in foreign currencies. Key hedging tools include forward contracts, futures contracts, currency options, and currency swaps. Hedging tools are financial contracts that allow you to lock in exchange rates or limit your exposure to fluctuations. Forward contracts are agreements that fix an exchange rate for a future transaction, providing certainty and protecting your profits. Futures contracts, on the other hand, is similar to forward contracts, but traded on a standardized exchange offering greater liquidity. Currency options are contracts that gives you the right but not the obligation to buy or sell a currency at a specific price by a certain date. They offer flexibility and potential for gains while limiting your risk. And last is currency swaps. This involves exchanging cash flows in one currency for another over a set period. They can be used to lock in interest rates or hedge against long term exposure. And for the last part, we have the management of international accounting and tax practices. Financial statements prepared in one country may be difficult to compare with those other countries. This lack of uniformity can make it difficult to assess the overall financial health of your multinational company. To address this challenge, companies need to be transparent, regularly and comprehensively disclosing reliable information about their financial condition and accounting practices, even across subsidiaries, is crucial. Various factors account for differences in national accounting systems. Legal systems. Different countries have different legal systems that influence accounting regulations. Cultural differences. Accounting practices can reflect cultural preferences for conservatism or transparency, and economic development. Developed economies might have more rigorous accounting standards than developing economies. Several international organizations are aiming to harmonize cross national accounting practices. International organizations like the International Accounting Standards Board or the IASB are working to establish a global set of accounting standards. This will make financial instruments or financial statements rather of companies from different countries more comparable for investors and analysts. Managers use the current rate method and the temporal method for currency translation. As said earlier, current rate method is the method that translates financial statements using the exchange rate at the end of the reporting period. It provides a snapshot of the current financial position, while temporal method, this method translates each item on the financial statements at the historical exchange rate in effect when the transaction occurred. It offers a more consistent view of the performance over time. Taxes are another significant consideration for multinational companies. Firms naturally seek to minimize their tax burden while complying with all regulations. This consists of direct taxes, indirect taxes, sales taxes, and value added taxes. Direct taxes are levied directly on corporate profits or personal income, while indirect taxes are levied on the consumption of goods and services like sales taxes or value added taxes. Moreover, governments use two major methods for eliminating multiple taxation: the foreign tax credit and tax treaties. When we say foreign tax credit, this allows companies to credit taxes already paid to a foreign government against their home country tax liability. And on the other hand, tax treaties are agreements between countries that specify how they will tax companies operating in each other's territories. Some countries offer themselves as tax havens, attracting businesses with low tax rates and favorable regulations. However, using tax havens can raise ethical concerns and come with increased scrutiny from regulatory bodies. And that ends our discussion for today. Thank you so much for listening.